All right, good morning, everybody. Thanks for taking a little time out of your day to join us for the Smart Beta webinar. My name is John Dahlstrom, and I'm the Director of Client Relations for Covestor. I'm based in Boston, and I'm available for questions following today's webinar, or feel free to reach out during the presentation. Here's my contact information. If I don't get to your question during the presentation or Q&A session, I'll follow up via email afterward. Now let's get started. First, we'll define beta, smart beta, and discuss the soaring popularity of smart beta products. Then I'll tell you a bit about the smart beta portfolios managed by Covestor Limited, which is part of the Interactive Brokers Group. Since we're a company that prides ourselves on transparency, I'll show you the inner workings of our smart beta portfolios, and I'll explain how they compare to other options out there. Then we'll have time for some questions. First, let's define beta. Beta quantifies exposure to the equity market by passively holding a diversified basket of capitalization-weighted stocks. For example, since the S&P 500 is a passive index whose weights are determined by the capitalization, holding the S&P 500 fund would equate to a beta exposure of 1 to the U.S. equity market. So what is smart beta, which is also known by many other names such as factor investing, enhanced beta, alternative beta, or strategic beta? Smart beta is exposure to the equity markets by holding a diversified basket of stocks that assign higher weights to stocks that have desirable characteristics. In a nutshell, getting exposure to smart beta means investing in equity markets by holding a diversified basket of stocks that assign higher weight to stocks that have desirable characteristics. Let's explore why investors might choose a smart beta over a beta investment strategy. Investing in beta portfolios means that you have an implicit belief that high capitalization is the most desirable characteristic that a stock can have. Basically, you believe bigger is better. Capitalization weighting, while having its merits, such as being more liquid, easier to trade, and typically having lower turnover, also has its downsides. For example, stocks that may be bubble stocks, which are stocks that have dramatic price appreciations within short intervals of time, get higher representation. For example, tech stocks were a big part of the S&P 500 before the tech bubble crash in 2000. Similarly, financial stocks were a big part of the index before the crash in 2008. The largest stocks, which are the ones with the highest weight in the beta portfolio, may have had their best days behind them since they have less room to grow. Because of their behemoth size, also these are passive products that do not consider stock fundamentals. Consequently, the beta portfolios own stocks that may have poor characteristics like negative price to earnings ratio. And a significant portion of the portfolio is concentrated in a handful of mega cap names. It is well documented in academic and practitioner research that factors such as value, growth, and quality, meaning solid earnings or balance sheet numbers, provide positive excess return over the long run over cap-weighted beta portfolios. Again, investing in smart beta means getting exposure to baskets of stocks with these desirable characteristics. Over the past decade, smart beta products have been growing in popularity, and for good reason. The smart beta investing wave continues to gather more energy. During the first quarter this year, investors steered $24 billion into funds using smart beta strategies, according to the Financial Times. That's up from $1 billion during the same period last year. That's a 2,000% increase in new money allocated to smart beta strategies. Smart beta investment strategies are one of the most powerful trends in investing, with assets under management now topping $500 billion according to Morningstar. That means that assets invested in smart beta products have more than doubled since 2012. BlackRock, the largest ETF provider in the world, predicts that smart beta funds could blow by the $1 trillion mark by 2020. In addition to BlackRock, financial firms such as Legg Mason, Fidelity, Franklin Templeton, and Covestor have launched smart beta products in response to growing demand. It's good company for us to be in. Let me respond to a question that we get pretty often, and what sets Covestor's products apart from products the industry giants offer. Covestor's smart beta portfolios strive to combine the best parts of smart beta investments that are made through passive ETFs with the best parts of actively managed mutual funds. On top of that, the basket of stocks are held right in your brokerage account. That makes it easy to see what you own, how your portfolio is performing, and you can buy and sell these portfolios as easy as you could a stock or an ETF. Covestor's smart beta portfolios offer certain potential advantages over both actively managed mutual funds and passive ETFs, including potentially higher returns, broad diversification, automatic rebalancing, and low fees and minimums. Let's take a closer look at some of the potential benefits to investors. For starters, we have priced the fee to be extremely competitive and one of the lowest offered for a smart beta product. At 8 basis points, or 0.08%, clients pay a very low cost for a managed portfolio. And with the investment minimum only at $5,000 US. So the annual management fee for a minimum investment of $5,000 US is only about $4 a year. Beyond the lower costs, the transparency Covestor provides is another big benefit over most mutual funds, which report results quarterly. Covestor uses a separately managed account structure. That means your stocks stay right in your brokerage account. It also means clients can log in anytime to see the real-time trades and positions in their account. No waiting for quarterly statements to know what you own or how your portfolio is performing. You can check the performance of your investments online anytime. This is an example of that you'll see on the dividend portfolio page. You can also adjust the time frame with your mouse to view performance for any period that you choose. That's a cool tool that Covestor provides. So you can see performance from the actual date that you started investing in the portfolio, not just say a 30, 60, or 90-day performance. Let's look at some more ways Covestor Smart Beta differs from most other offerings. These portfolios also use a nifty feature called fractional shares. For those of you who aren't familiar with the term, fractional shares let you invest in a broad basket of stocks, even with a low investment, by letting you buy a fraction or part of a share. For instance, most of our smart beta portfolios provide exposure to roughly 300 stocks, and Covestor's broad market portfolio provides exposure to 1,000 stocks, whether you have $5,000 or $5 million to invest. In addition to helping you diversify, we take care of everything from crafting to rebalancing the portfolios for you. To begin with, Covestor's Chief Investment Officer, Sanjoy Ghosh, and our investment team carefully constructed the smart beta portfolios, and then they rebalance allocation in each portfolio on a quarterly basis. Our technology replicates these changes in clients' accounts, so the hassles of stock picking and rebalancing are taken care of for you. Sanjoy is a seasoned investment professional with expertise in multi-asset portfolio construction and optimization allocation across a broad range of asset classes. He began his investment career at Putnam Investments, where he started as a quantitative analyst and was a member of the portfolio management team responsible for the U.S. large cap growth structured equity portfolios. Prior to Covestor, he was Director of Investments and Portfolio Manager for Panagora Asset Management, where he oversaw alpha research for Panagora's equity and multi-asset strategies. He also led the new investment product portfolio development for several of the firm's products and was a member of the investment committee. Sanjoy has a BA in math and economics from Colgate and an MA and PhD in finance from the Wharton School of Business at the University of Pennsylvania. So here's how Sanjoy and his team create these smart beta portfolios, which are diversified baskets of stocks that are selected for their desirable characteristics. Let's take a deep dive into some of the characteristics we consider. For instance, value characteristics. We look for attractive valuation ratios such as book or balance sheet value to price, which is market value, and earnings to price ratios. In general, companies with high book to price and earnings to price ratios are viewed as attractive, since it means that you aren't overpaying for these stocks. Of course, it could mean that some of these companies are not well managed and may be on the way to bankruptcy, but by applying certain filters, like excluding companies with negative book value, you potentially reduce this risk. Also, by looking at forward valuation metrics like forward earnings to price ratios, you can avoid buying into companies that are forecasted to have earnings difficulties. Our value portfolio does all this and more. The value portfolio, which has the trademark name Valcov, invests in approximately 300 stocks. That helps to ensure that there is adequate diversification and avoids risk concentration in just a few names. The highest stock weight is less than 1%. Covestor's value portfolio uses a volatility adjustment to ensure that the portfolio holds stocks with price stability and picks stocks with the most attractive valuation characteristics by comparing them versus their sector peers, and thereby avoiding sector biases. Similar methods are followed in the growth, quality, and dividend portfolios. For the growth portfolio, nicknamed GROCOV or GROCOV, we look for stocks with attractive growth earnings. For the quality portfolio, or QALCOV, we seek stocks with strong returns on assets. And for the dividend portfolio, we typically pick stocks that pay out dividends. We offer these portfolios in both large and mid caps or a small cap flavor. We also offer broad market portfolios that blend cap weighting and equal weighted broad market exposure across 1,000 names. After we carefully construct each portfolio and backtest it thoroughly, we keep an eye on the investments and rebalance the portfolios each quarter. Rebalancing involves regularly realigning the weightings of a portfolio's asset allocations in a disciplined way to stay on track with your investment goals. Traditional passive investment products typically do not have a rebalancing feature. Here's the process that Covestor uses to rebalance the smart beta portfolios. Every 3 months, we automatically generate target weights for all smart beta portfolios based on their respective allocation factors and criteria. For example, we consider sector relative dividend yield for the dividend portfolio. The smart beta portfolios are traded to bring them in line to the target allocations, and the same trades are automatically made for your investment in each smart beta portfolio. Clients do not need to do a thing. And clients can view holdings in their account and check performance on their customized client dashboard at any time. Please note that there are brokerage commissions for rebalancing transactions and tax reporting implications to rebalancing trades, which you should understand before investing in one of the smart beta portfolios. These are discussed in the risk disclosures for Covestor smart beta portfolios on the Forms and Agreements page on the Covestor website. Since we're a company that prides itself on transparency, let's take a closer peek inside our portfolios. When you go to Covestor.com and click Investment Portfolios at the top of the page, you can see the full range of products that we offer. You can click on any portfolio name for more information. For example, click on the growth portfolio and you'll see a wide range of information, including a detailed description of the portfolio, the investment management fee and investment minimums, how the portfolio has performed versus its benchmark, and the portfolio's performance. And on the lower half of the page, we provide even more information, including sector exposures, smart beta related articles, the latest transactions, and even more. So far, we've covered several potential advantages such as low fees, transparency, competitive performance, diversification and low investment minimums using fractional shares and automatic rebalancing, and the in-depth, easy to understand information we provide online so you can get more details, or you can contact us by phone, email, or chat. We also make it easy to buy and sell these portfolios online or with our assistance. Here's how the online investment process works. First, go to Covestor.com and click on the Investment Portfolios tab at the top. You'll see the Smart Beta product lineup as well as the other investment portfolios that we offer. Next, click on any portfolio and you'll see a blue Invest button on the right. When you click on that button, you'll be directed through the next steps, and don't hesitate to contact us if you have any questions or need help along the way. So I hope you found today's webinar helpful and learned more about Smart Beta and why investments in Smart Beta products have grown in interest. I'd be happy to answer any questions. Also, if I don't get to your question in the few minutes that remain, I'll follow up with you after this webinar. Before I take the first question, on the Covestor website, you can view forms, disclosures, fees, and brokerage charge information. You can also review disclosures about brokerage and trading arrangements and associated conflicts of interest that make offering the Smart Beta portfolios possible. And you can learn more about the tax implications of investing in the Smart Beta portfolios and trading constraints around rebalances, and review hypothetical back-tested returns for these portfolios. Now we do have a couple questions. Let me answer this first question come in. It says, can you review the fees I pay for your Smart Beta portfolios? Are there any other fees like entry or exit fees? So yeah, that's a common question. It's so with Covestor, we never charge any entry or exit fees. We don't have load charges either, like mutual funds. We also don't charge you for uninvested cash in your account. We charge an annual management fee of 8 basis points for our Smart Beta strategies, or 0.08%. Another question is, do you have any performance data longer than the inception date? So that's a good question. We did launch these strategies late last fall. So the Covestor investment team carefully back-tested each Smart Beta portfolio going all the way back to April of 1999. We calculated back-tested hypothetical returns with the benefit of hindsight, attempting to indicate how these portfolios would have performed in past periods if they had been in existence then. You can see the hypothetical returns on our website. You'll just need to review disclosures. It's a simple button that you click. Hypothetical returns, they don't reflect actual trading, so that's why they're hypotheticals. If you want to see the hypothetical returns, you can view those details right on the website anytime. Okay, another question we have is, how is an investment in Covestor.com, so a Covestor account coupled with an IB account? We do have, IB has what's called account partitioning. So if you were to visit Covestor.com and you saw Smart Beta, for example, at the top right of the page is a green button that says sign up. That will start walking you through the sign-up process to become a client with Covestor. There's a question right on that first slide called, it says, are you an Interactive Brokers client? You simply answer yes, you sign our agreement, and we'll bring you automatically back to Interactive Brokers website, where you then can partition a portion of your free cash. So it's very easy. That's how it works. So good question. Another one that has come through. It's does your portfolio have long and short positions? Smart Beta will not hold short positions. Currently, they're all long stocks, and we do have the ability to buy some ETFs. So the quick answer there is no short positions in Smart Beta. Another question, how many portfolios can I invest in at a time? The answer is as many as you'd like. Covestor offers dozens of strategies, including the Smart Beta portfolios. For the Smart Beta portfolios we launched in late 2016 have a risk score of 2 or 3. So you just have to meet the certain risk score and, of course, meet the minimums to invest in each strategy. One more question. It's can I invest more or less than the minimum amount? You just have to meet the minimum amount, and you can invest as much as you'd like into any one of our strategies. Again, Smart Beta has a minimum of 5,000. Our other marketplace strategies start at 10,000. They go all the way up to 130,000 per strategy. So it just depends upon how much you want to invest. So that's all the time we have. There might be some more questions. I'll definitely get back get to the others via email. I have your information, so I'll definitely answer them. So thanks for your time, and don't hesitate to get in touch with me. Appreciate it.